Okay, welcome. Welcome. Well, thank you again to joining Guide Technologies and Avalara for today's webinar, How to Cut Costs, Not Corners with Tax Compliance. So today we have Evan Owens, who is the Senior Strategic Alliance Manager at Avalara, as well as Rich Creech, who is the Sales Executive at Avalara, and myself, Wendy Broom. I'm the Marketing Director here at Guide Technologies. So we're so glad to have you here today. This webinar is meant to be interactive. So if you have questions or comments, please drop them in the chat throughout the event, and we will address those at the time or at the end during Q&A. So with that, I hand the floor off to Mr. Evan Owens.
Thank you very much, Wendy. Appreciate that. And thanks everybody for carving some time out of your day to learn about sales tax compliance. As Wendy said, my name is Evan Owens, and I'm responsible for managing Avalara's partnership with Guide Technologies, and I work in the greater Infor ecosystem. Make my home in Folsom, California. If you've ever heard of it, you're either a Johnny Cash fan or you've been in the area. And I've been with Avalara for 6.5 years and spent a couple years working at another company in tax technologies as well. And I'm being joined today by my colleague, Rich Creech. Rich, did you want to say hello real quick?
Yeah, can you guys hear me?
Yep.
Oh, so I'm a sales executive here based in Cincinnati, where Guide's located. So it's easy for me to shoot over and see the Guide team anytime that's needed. So
awesome, thanks. All right, so jumping in the agenda today, we're going to talk a little bit about how tax compliance has changed over the last several years. There's an important Supreme Court ruling that took place that you may not be aware of, and then kind of look at the cost of managing tax compliance manually, and then some tips to streamline that process. So see if I can find it on here. Before we get started, or as we get started, one of the things that changed dramatically is how companies establish Nexus. So for those that are not familiar, Nexus in the sales tax world refers to a company's obligation to register their business to collect and file taxes in any given state or jurisdiction. So that's what that term refers to, is that connection that is established between your business and the taxing authorities. So right before we get started in here, I'd be curious to do just a quick poll of how many states you believe your business currently has Nexus. And I think the choices on there are 1 to 2, 3 to 5, 5 to 10, or 11 or more. And if you wouldn't mind just clicking the box that applies to your business, give it a couple more seconds. Okay. All right, so the typical way that Nexus was measured in the past was by physical connection. So businesses would set up their company, they would get a business license, and in exchange for that business license, you get the friendly requirement by your state taxing authority that you're now responsible for collecting and remitting taxes. You don't get paid for that honor. It's just an expectation of all companies that register and establish their business. And over the years, it was widely regarded as you had to have a physical connection in order to be responsible for those taxes. So in 1992, a little quick history lesson here. In 1992, there was a Supreme Court ruling between a company called Quill and North Dakota. And North Dakota sued Quill, saying that Quill's business model, which was selling office products into various states via catalogs and CDs, and then shipping that product based on online and faxed in orders, that they should have to register and file taxes in those states, and in particular North Dakota. And it went all the way to the Supreme Court, and the Supreme Court said, no, we don't agree with this requirement because there's no physical connection between Quill and your state other than the commerce, right? There was no businesses or buildings located there, there were no employees located there, and so Quill would not be required to register and pay taxes, file taxes in that state. And that's the way it was from 1992 all the way until 2018. And then there was a company called Wayfair, and South Dakota sued Wayfair. So I don't know why all the Dakotas are getting in these tax wars, but they do. And South Dakota sued Wayfair, which is a large furniture retailer, and said, you guys are doing business in our state. People are ordering furniture online, having it delivered into our state. You're creating a competition for our existing businesses that are here, that are paying our taxes. And we think that if you're going to do business in our state, you should have to register and file. Well, as we all know, a lot changed over those years between 1992 and 2018 when it comes to how we buy, right? A lot of things are purchased online. And for many years, we all enjoyed not paying sales taxes on those purchases because there was no physical connection. Well, this time around, the Supreme Court saw it differently. This time around, they realized that there were a lot of economic pressures placed on the states, a lot of economic pressures placed on brick and mortar buildings. And so this time they sided with what is now referred to as economic nexus. And in the case of South Dakota versus Wayfair, the law that was established was that if there was $100,000 in sales or 200 unique transactions, then that state would have to register and begin collecting and filing taxes. So that law passed for South Dakota, and then basically that created a gold rush for all the different states to create their own set of rules and policies for that to be enforced. So as you fast forward to today, this is what a map of the various economic nexus thresholds by state are. So you can see they're not the same. South Dakota has their 100,000 or 200 transactions, but you can see a lot of states just went $100,000 and we want people to register and file. Some of the larger states like California, Texas, and New York, the larger populated states, those they've made it 500,000. But as is always the case with sales tax, we can't just all do it the same way, right? It's the good and bad thing about our country sometimes is that we have 50 unique kingdoms and they all get to make up their own sets of rules and their own requirements, and everybody's just got to learn how to play in all those different places. You can also see under the amounts there that some of the states have made changes. When they originally rolled this program out, Kansas required everybody from $1 to register, and then realized that that was way too many companies to try to keep track of, and they backed it down to the $100,000 threshold. So the one thing that is very interesting about this term economic nexus, and just all the time I've spent talking to companies about it, is that a lot of people perceive economic nexus to mean e-commerce. So when this ruling came out, I think a lot of businesses in the manufacturing space went, well, I don't think that really applies to me. We don't really do internet sales per se, right? And so a lot of companies just kind of disregarded this ruling. And as it's evolved, what they've come to learn, some companies the hard way, is that this really doesn't have anything to do with e-commerce. It just has to do with remote sales. Essentially, any product you're shipping into a state where you don't currently have Nexus needs to be considered. So as we look ahead and we look at exempt sales, and most of the folks in the manufacturing world, that's where the lion's share of their business is done, is via exempt sales. You can see here all the green states on this map are states where they look at total sales, not taxable sales, when determining these nexus thresholds. So if you're selling $100,000 into South Dakota and it's all exempt, you still have to consider the fact that you crossed that threshold with exempt sales as well. And this is something I think that's gone largely unnoticed by companies in the manufacturing space, is that because their sales are exempt, they often think that they don't have to pay attention to these rulings, but they do in fact have to.
And
you can also
Evan, can I interrupt you on this? Because this
absolutely, Rich, go ahead.
This is what I run into every day. So just for an example, I had a customer based in Florida that was doing business in 45 states. So they were exempt 100% basically in every state. 99.9% of their business was exempt. Well, they had never collected exemption certificates outside of Florida. California came and sent them a notice for audit. California said, why are you doing $8 million of sales in our state and not registered to pay sales tax? Well, the customer obviously thought they were 100% exempt in California. That's fine. California agreed, said, okay, if you're exempt, and I want to see all your exemption certificates for all your customers in California. They had 0 exemption certificates. California would not let them go back to their customers because they're supposed to be on file. at the time of purchase. They would not let them go back to those California customers and gather those exemption certificates. This customer ended up getting fined penalties, interest, and back taxes of $2.4 million, and there was nothing they could do about it. They went on a payment plan, had to pay the state back, you know, for not being registered, not collecting exemption certificates, and they had to do this for all their customers in California. What they ended up doing is running an exemption certificate campaign through Avalara for the other 44 states. They wish they would have done that in the beginning, because they ended up the $2.4 million, which paid for a lifetime of Avalara services probably. So I just wanted to point that out, because I run into this every day with all my customers that think, well, we're fine, we're exempt. They're only fine if they're collecting exemption certificates. So if you take one thing out of this, make sure you're collecting exemption certificates in all the states that you do business. Sorry, Evan.
No, you're good. You're good. I appreciate that. Yeah, and I mean, I think that's really what Avalara's philosophy has always been in situations where we're doing, you know, webinars and things like that. Of course, we want everybody to be an Avalara customer, but we also would much rather have a customer that comes to us because they're strategically looking at their tax strategy and profile and making sure that they're compliant and making sure that they're automating it in a way that makes sense for their business, and not because California has slapped them with a huge fine, right? And as a lifelong resident of California, can I just say, leave it to California to be that rigid. They're always the worst. Okay, so moving on to the next slide. So one of the things that we've seen over the course of this Supreme Court ruling is just how much it multiplied the typical company's tax footprint. So in this slide here, we're talking about that the average company saw between 6 and 9 times the number of states that they had to be considered, they had to register in based on this ruling. And also this map here is kind of cool because it shows what an Avalara customer sees or would potentially see when they're using our service, because we track sales into all the different states, and if you're not registered in a state, then our system would track that, and you can see this heat map where you can see, you know, in this particular example, which is showing, you know, multiple states here where you've exceeded threshold. But one is the user can look and see where they're approaching threshold, where they've exceeded threshold, all the places where they're, you know, already currently registered and collecting, so that they can see where they're starting to trend into the area of having to be concerned about their overall tax footprint. So some of the other things that we've kind of just seen over the last few years, you know, I mean, supply chain issues almost become like a you know, a joke expression because it's so widely known that everybody, I mean, even as a consumer, if you go into a store and you're buying something, you just know the supply chain's been a challenge. And certainly nobody's felt it more than the companies in the manufacturing space. And many of the companies are looking at, you know, things like staffing shortages and things of that nature, but also some of the issues around when they need to deal with supply chain issues, how that might affect, you know, adding new products to the segment, adding new suppliers, having to make sure that they have exemption certificates on file for those new suppliers, handling drop shipping, all those sorts of things that make being in the manufacturing space so complex. As a personal story, I ride a mountain bike, and about 1.5 years ago, I ordered a new mountain bike, and this is when you couldn't almost get anything the day you wanted to buy it. You had to go in and place an order. And so I placed an order for this mountain bike, and a couple months later, the bike shop called to let me know that it was in. And he said, I have good news and bad news. Your good news is your bike's here. The bad news is they didn't send a handlebar stem. So for those of you that ride bikes, the handlebar stem is what connects the handlebar to the tube on the bike so you can actually steer the thing. Kind of an important piece, but it's a small little thing that just didn't ship because the manufacturer was out of them. So the bike shop had to give me an aftermarket handlebar stem. And it was just an interesting moment for me to think about all the different ways that the supply chain affects all the way downstream, right? To having a situation where now this bike shop's got to figure out how to sell this thing at no cost, and they have to deal with whenever the other thing does come in, what do they do with that? So the complexity of supply chain issues kind of knows no bounds, and it does even trickle into the sales tax world when it comes to setting up all these suppliers and setting up exemptions and all the things of that nature. And then the other thing that we've seen quite a bit of is just watching how states respond to economic upticks and downslides, right? So we For years before the economic nexus ruling was passed, we were seeing a lot of pressure on audit from states because they wanted to make sure to capture every dollar because they were losing so much when companies were not having to collect tax because of economic nexus. And then when COVID came along, there was a huge hit on the economy and a lot of businesses were struggling and a lot of states kind of backed off a little bit to give them a chance to recover. But then once they did, boy, have we ever seen a lot of audits, a lot of increase in the number of audits that are happening. So states are looking at, how to recover from those different downturns, and they look at things like auditing, they look at things like new taxes on products that weren't taxed in the past, and increased tax rates, which means that the rates that businesses are charging are changing as a result. So diving into the next part, a little bit about tax compliance done manually. So this is a map, kind of interesting to see. It's basically a map showing all the different jurisdictions that there are in the United States. And it's pretty astonishing when you look at just the sheer number of different forms of data that have to be maintained. There's 12,000 jurisdictional boundaries. There's 35,000 sales tax rates. There's 30 million product or service exemptions and 750,000 buyer and seller exemptions. So when companies are trying to do all this process on their own, there's a lot to consider. And the bigger your company gets as far as footprint goes, as Nexus footprint goes, the more complex it gets because there's the different rules for all the different states that you now find yourself doing business. So this slide here was taking data. It's a few years ago where they did a survey and they were asking different tax professionals if they were audited, what's the likelihood that they think the mistakes would be found in their tax profile? And 25% of them said, no, I think you're not likely to find mistakes. And 75% said that they were somewhat likely to definitely. And I think that what's interesting about this is that I think everybody tries to do the best they can at managing the tax compliance element of their business, but there's just so many other things that are going on that take priority over making sure you're on top of all those changes, right? There's always pressures on us to make sure we're doing more with less, and people are often wearing many hats in their companies, and making sure that you're staying on top of something that doesn't tap you on the shoulder sometimes can really cause you to get behind. The other side of the slide is showing kind of a range of everything from a small business up to a much larger business, kind of what the cost of compliance is as a general rule, looking at salaried employees and subscriptions to data and things that they need in order to make decisions. When they take kind of that all together and they look at that, it's the average cost. And then this one here talks a little bit about the cost of doing business as usual, right? It's showing you small and mid-sized companies and how many hours are spent in the course of a year of trying to administrate taxability changes, preparing tax returns and making the filings, managing the audits, et cetera, exemption certificates. It's one of those things where it seems like a small job when you just think about managing tax compliance, but when you get into the nuts and bolts of it and all the elements that are included in the process, it can really add up to a much bigger job than you maybe are paying attention to. So a lot of companies, that get spread around. Sometimes it's a single person whose job it is to do all of that and maybe 2 or 3 other things. And as I mentioned on the previous slide, it's just an easy thing not to do sometimes. And that's where many of the companies we talk to find themselves in trouble, is that they were doing it and they just, let their guard down because they put their attention on other priorities. So some of the tips to streamlining sales tax. This here kind of just shows the 5 main elements of a tax compliance strategy, and then kind of ties to some of the products and services that Avalara has to help companies automate that process. So first step is knowing where you need to be registered. That's kind of what the first part of this presentation was about. It's understanding your Nexus footprint, understanding how South Dakota Wayfair impacted you. I do these presentations a lot, and sometimes they're in person, and I'll say show of hands who's heard of South Dakota Wayfair. And it's not uncommon for 5 or 10% of the room to raise their hand, and everybody else doesn't. And so that tells me that a lot of businesses just have really never taken a hard look at it. So if you haven't, please do. Whether you decide to work with Avalara or you decide to keep this something you do yourself, please do take a look at your Nexus footprint. It's the first thing that sets you up for failure or success, is being registered. Because if you're not, then that's obviously, you heard Rich's story. That's where it can get companies into a lot of trouble. Then the next step is ultimately getting registered, right? Which brings about its own unique sets of challenges where, if you go and you register, then the question is, why are you registering now, right? So some companies will employ either Avalara or their tax firm to do what's called a voluntary disclosure agreement. And what that enables them to do is to go to a state anonymously. You actually send somebody as a proxy. In the case of Avalara, it'd be us. And we would just say, hey, we know somebody who's been doing business in your state, and they are concerned with being compliant, but they also want to avoid and minimize their exposure as much as possible. And the states will often pre-negotiate kind of a settlement of taxes and waive fines and things of that nature so that a company can register, have amnesty for their past activity, and move forward in compliance. And then ultimately just getting registered for all those various states, Avalara can automate that process as well. And I accidentally skipped over on the first part. Avalara does Nexus studies and research. So when you're evaluating your Nexus footprint, Avalara can help you kind of with research and tools and consulting to help you understand where your business is today and what potential business activities might be affecting your exposure and your need to register in these other places. Moving on to the third section, calculate. That's the heart and the core of what everything of what Avalara does. It's what most people think of. If you say Avalara to people, they say, oh, they calculate sales tax. And for some manufacturing companies, that's a big challenge. If you're selling anything through an e-commerce site, or if you have a parts department that sells parts to replace, existing ones or accessories, things of that nature, we do have many manufacturers that we work with that have quite a bit of calculation to do. And if you do that part of your business, then you know that all those rates can change, and all those rates have to be applied differently in all the different jurisdictions. And so we have this huge team that it's over 100 people that manages all the boundaries and the rules and the rates and the taxability and all the things that make tax calculation complicated. They stay on top of all those items so that customers that are using our service don't have to worry about keeping that up to date. And then we move on to exemption certificate management. And this is what candidly affects most of our manufacturers the most. And this is, as you heard in Rich's story, this is where often auditors go first to look, right? This is the easiest thing to mess up. If you're supposed to be collecting 7% and you're only collecting 6.5%, they get you for half a point. If you're supposed to be collecting 7% and you're not collecting anything, they get you for 7 points. And that's a big, big difference to them. Also, exemption certificates are often established and set up by salespeople who are just trying to get a new customer in place, right? They're trying to make sure they get the order shipped on time. This new customer they're excited to have on board, they want to make sure they give them a great experience. They don't want extra paperwork, and they're not usually the best person at understanding what is required in order to make sure that that is a compliant exemption certificate. Once it's collected, it's either filed away into a file drawer or banker's box, or maybe into a digital document storage where the image is captured. But we have no idea if it's an accurate image or when it expires or that it's for the appropriate products that are being sold. We just know that there's an exemption certificate on file. And if there's an error in that certificate, what states will often do is when they're auditing, they'll look and they'll go, okay, well, there's X number of sales and there's X number of exemption certificates. And we found that 5% of those certificates were invalid. So 5% of your sales are out of compliance. And now the burden is shifted from the auditor to the business to try and backpedal and figure out how to prove what their compliance is. And of course, we get penalties and fines and all that fun stuff on top of it. So it's a very important piece of your tax compliance strategy. So whether that's something you do well yourself, make sure you're on top of it and just register in the right states. But if you want a tool that can help improve that process quite a bit, Avalara has one that allows you to reach out to your customers via a wizard. They can fill it out online, send all the information, attach the document, attaches to our system. And then if that certificate's ever out of compliance, if it expires, then it's going to charge tax, which will create a conversation, right? And if you have a lot of customers that have all these certificates, you can actually run reports to find out when they will be expiring and push that notifications out to those customers so they can update them in advance of the exemption certificate expiring. So keeps your business in compliance. The thing that's interesting about being in this world where you're collecting and remitting taxes for states is that the tax belongs to the company. You're just allowed to pass it through to the consumer, right? It's a pass-through tax. But ultimately, the business is responsible for it. So the business is the one that needs to make sure that they are keeping everything compliant and charging where they're supposed to be, so that they don't get in the spot where they have to pay it on behalf of the customer. And then the last step of the process would be remitting the tax to the various taxing authorities, right? If you're in one state and you file quarterly taxes, it's probably not a huge lift for you to do that. If you're in 25 states and some of them want it to be quarterly and some want it annually and some want it monthly, and you have to keep track of all the calendars and you have to keep track of which ones give you a little discount if you pay it by a certain date, it becomes a big animal. It becomes very difficult to stay on top of. And you have to go to each state and you have to fill out all the different forms and you have to upload them. And if you're in that world, I'm not telling you anything you don't know, but it's a very complex and very time-consuming endeavor to stay on top of all the various returns and all their due dates and et cetera. So as part of the Avalara solution, many companies opt to have us just take that on for them, right? We've already captured all their transaction data. We've got all the sales reports that show how much they sold, what was exempt, et cetera. We can populate the forms, do a single ACH draw, and pay all the states and jurisdictions on behalf of our customers. And that's kind of the overall tax strategy and kind of how we align. If there's pieces of that make sense to you and other pieces that don't make sense for you, we'd still love to talk to you more about how we can fill in the gaps in your overall tax strategy. Last thing I wanted to share with you before we wrap up is something called Streamline Sales Tax. I'll let Rich explain that to you guys.
Yeah, Evan. So this is one of our major benefits. We are a certified provider of what's called the Streamline Sales Tax Initiative. What that is these 24 states came together and basically unified to get people registered in their state. This is a benefit to you as a customer because what it does is gives you uniform definitions and rules in all these states. Avalara will do free registrations for you in any of these 24 states. We'll do free transactions for tax calculations in these states. So you're not getting charged for any calculation that we do in those states if you qualify. We do free return prep and filing in these states for you. And we also give you audit protection in these states that you qualify for. So the Streamline Sales Tax, you're like, why are they giving all this to us for free? Well, there's a catch. I mean, these states are paying Avalara to be a service provider. So we're passing it on to our customers. We do the services for free. They just want you to get you registered. They want to make it easy for you to register in their state. But to qualify as a volunteer in these states, there's only a few questions you have to be able to answer in a 12-month period. You can't have a fixed place of business for more than 30 days in these states. You can't have more than $50,000 worth of property in these states. You can't have 50,000 or more in payroll in the state. So if you have an employee and they're making over 50, you wouldn't qualify for the program. And you have to have less than 25% of your total property or payroll in the state. The biggest one that most of my customers disqualifies them is they have an employee in the state and they're making over $50,000. But it makes it easy for you to get registered in these states. We'll do the registration for free. We'll do the calculations for free, and we'll do the filing in these states. So if you were registered in 45 states and 24 of them you qualify for this program, we're going to do all that work for you for free, and you would pay us for the basically other 21 states that you're registered in. But it's a great program. It's one of the benefits of doing business with Avalara. You don't have to be part of the SST program, but it is a major benefit for you as a customer if you did decide to come on and use our services.
So just to clarify, Rich, so if I had an employee in Minnesota that would disqualify, or that made more than 50,000, it would disqualify me from actually, I'm not sure if it's the blue or the white ones. Not the other ones, right? Like I could still get 23 states. Yeah.
Yes, you would. I mean, you could still be a member and you can be a member in 10 of the states and disqualified for 14 of the others. But
right. So it's not an all or nothing proposition. Yeah.
It's not an all or nothing proposition, Evan. We just try to determine before you apply for the program what states would you'd be disqualified from.
Got it. Thank you.
Thank you.
Okay. Yeah. All right. So that was kind of the end there. Actually, it looks like we kind of got our slides backwards. My question slides after this one, but so I guess I'll just go back. I'll go back. There you go. So Wendy, I don't know if anybody posted any questions, but if they did, we'd love to answer them.
Yes. Hi, Evan and Rich. Thank you so much. We do have a few questions. Dave asked, how is Avalara implemented?
Well, I can take a stab at that, Rich, but do you want to do it, or I'll do it if you want me to?
Go ahead, then I'll add in.
Okay. Yeah. So we actually work with Guide Technologies on implementation. So they're a certified implementation partner. So that means that they have staff that have gone through training with Avalara. So that one of the nice things about them being certified with us is that when you are already used to working with their team and you decide to purchase Avalara's services, then you can continue working with the Guide team. But effectively, there's depending on which platform you're on, whether you're an XA customer or a Syteline customer, we have pre-built integrations to those products. So those products essentially tie into the invoice creation part of the ERP. And so instead of it looking at your own internal tax tables that you have to maintain in order to figure out what the tax rate would be, it pings Avalara via web service. And I mentioned we have over 100 people that keep all those rates and rules established. And so essentially the setup is getting that connector connected to your ERP so that the systems are talking to each other, and then setting up your products and your different services in the system so that it knows what you're selling and can apply the correct rate to the products and services that you're selling.
So yeah, we're doing a basic map. We're doing a mapping from your item numbers to our Avalara tax codes, and there's over 3,000 different tax codes you can choose from. Majority of our clients distinguish between freight and services, and if there's an item that has a specialty in a state, then we want to know about it. But a lot of your products are probably tangible personal property, which makes the setup a lot easier. But it's just getting those item numbers mapped correctly to our Avalara tax codes, because we have the content in every state. That's how we identify the taxability.
Cool, thank you.
Okay,
Sorry.
thank you, guys. Dave says thank you. I have another question from Brian asking, how much does Avalara cost? Can you speak about your pricing model?
It ranges. Basically, we're transaction based, so it really depends on how many invoices, and determining if you qualify for the SST program in the state's a huge money saver for most of our clients. But it just really ranges from how many invoices are you producing into the states that you're registered, how many exemption certificates are we storing, and it's based off of your returns filing schedule. So we would need to know how many returns are you currently filing, how many should you be filing in the future. So we make a determination. It's all based on volume. Everything we do is based on volume. So we have customers that pay minimum. We have customers that pay us quite a bit. So it would just depend on your volume and working with me to determine how much it would cost.
Great, thank you.
I don't mean to dance around it, but every customer varies.
Yeah, basically the bigger you are, the more it costs, but obviously there's economies of scale mixed into that as well. So
yeah.
Great. And we have one more question. Janine is asking, we're interested in learning more about the free sales tax risk assessment. How does that work?
So basically we'll get in contact with me and we'll walk through it, and we can do that for you. I can do that for you, not a problem.
Perfect. Well, if we can move back, there we go, to the slide with Rich and Evan's emails. Here you have their contact information if you would like to take advantage of the free sales tax risk assessment or have any additional questions. Also, a follow-up email will be landing in your inboxes tomorrow. It will contain a link to this webinar so you can use it for future reference. And we'll also include a link to one of Avalara's YouTube videos that you will find helpful and informative. And with that, we have no more questions. So once again, I thank everyone for joining us today, and we will be following up with you tomorrow, sending you some communication, and please contact Rich or Evan as well with any additional questions that you may have.
Thanks, everybody. Really appreciate the time.
Absolutely. Thanks, guys.
Thank you, everyone.